ready to peer behind the curtain of the private equity universe with each episode of Best But Never Final. Hi, I'm Lloyd Metz, joined by Doug McCormick and Sean Mooney. Together, we'll navigate the corridors of private equity, revealing the uncommon knowledge, challenges, successes, and lessons that drive the world of private equity and business forward. Let's go.
It is awesome to be back with Lloyd and Doug. Doug and Lloyd, how are you guys?
Good.
Good, Sean. Good to see you guys. Hey, Doug.
How you doing, Lloyd?
Doing good. Doing good. What's on deck for today, Sean? What are we talking about?
We got a good one here. We are going to talk about the difference between academia and reality, between truth and fiction, between how academics value companies and how the PE pros do it right.
Wow, that's a good one.
I think we'll talk about how PE pros do it. I don't know if we're going to talk about how PE pros do it right.
Every time I did it, it was right. The ways I got to that number were never the reasons I thought they would, though.
You know that old saying, two kinds of models, lucky and lousy. They are always wrong. It's just a quantum of wrong and how you got there.
So why don't we do this? To get into this conversation, let's talk about how the academics do it. And for the toss-up here, what I want to ask is, what were each of your grade points coming out of business school to see who actually knows what the academic approach is better? Okay, 1, 2, 3.
Doug, you got this one.
Front row Doug, as he was known back in business school.
Awesome. I'll take it. Hey, Lloyd, thanks for that, man. I appreciate you nominating.
Hey, you're welcome.
So I'm on the hot seat to talk about how academics do valuation work. Is that what I'm hearing?
Yeah. How do they teach in business school? This is how you value a company.
The most common approach that academia embraces is discounted cash flow analysis. There's a pretty common belief that there are three fundamental pillars of valuation. So one is the discounted cash flow analysis. The second is public market comparables. And the third is kind of comparable transactions. What are we seeing in the marketplace? Comparables differ from public comps in the context of they're often private marks. They don't have to be. They reflect what someone's willing to pay for control. And they're a discrete point in time versus being able to look at the public's over time. And just to maybe just put a little more meat on the bone with discounted cash flows, obviously that is an attempt at forecasting what the business is going to do over generally a 5-year period. And we can talk about the challenges or inadequacies of that. And then lots of assumptions around what the cost of capital is, what the balance sheet looks like, and ultimately what cash flows are generated from that business over the forecasted period. So those are really the three key metrics that people think about and then usually use some combination of those to triangulate around a common belief, if you will. Let me just stop there. Questions, reactions to the description before we beat it up and tell you why those are no good?
I don't know if they're no good, but I think you characterize it the right way. Those are the three main pillars. And with the DCF, it is a good exercise. And I guess we'll talk about it some more later, but developing those assumptions that drive the revenues, that drive the cost structure, that drive the operating cash flows, the assumptions behind CapEx, the assumptions behind the net working capital and the asset intensity of the business. Those are good things to think about and be mindful of for sure. I think one of the bigger things that you learn as you come out of business school and get into the real world is that it's not just one output answer, right? There's a range around your assumptions. It's not a super precise exercise, right? This valuation. You have a range of growth rates. You have a range of assumptions around receivable days or payable days. So you put ranges around all of those things and you kind of sketch out an area of valuations, I think, when you play around with it. But that exercise is useful to develop a better sense for what drives value. And the bigger piece, and you probably remember these days, Doug, terminal value in that DCF is a big driver for a lot of companies.
I think actually mathematically for all companies in a 5-year discounted cash flow model, I think something like 75% of the answer is the terminal value assumption. So it's always way back end loaded. First of all, I agree with you that the process of building the DCF model, I think is excellent because it forces you to explicitly wrestle with the assumptions that are going to drive success or failure in the investment case. So I love the discipline of it. The shortcomings are in how it's used and how you like derive value from it.
That's right.
To transition, let's talk a little bit about the shortcomings of each of these three, and that'll help us also talk about the positive things. So I think the shortcoming of the DCF in my mind is the long dated nature of the assumptions and the accuracy or the precision that you can forecast that far into the future. That creates a challenge versus I candidly think most investors are much more simplistic about what's the financial performance today. And if I capitalize that as a multiple of cash flow, I think that is generally much more of a reflection of like where the market is than someone's ability to underwrite long dated forecasting. The two other big negatives for me are the terminal value assumptions are pretty academic based on cost of capital. You can do much better by looking at other precedents in the marketplace or how you think about exit. And the overall cost of capital assumption, how people think about weighted average cost of capital and tax affected weighted average cost of capital versus saying, I know the market will lend 3 times leverage or 4 times leverage. I know that interest rate's going to be 10%. And I really care about my equity return, not my discounted cash flow based on some weighted average cost of capital. So anyways, I think we talked about the positives of the DCF. I kind of gave you some of my views on the challenges of making it practically useful. I'll stop there for a reaction.
Yeah, it sounds like, Doug, your last piece that you mentioned is you're describing sounds like a leverage buyout model as sort of a fourth, I don't know if it's a pillar, but it's a fourth approach to thinking about valuation, yeah?
Yeah, and I would say to me, that's probably the one that is most interesting and relevant, and in many ways is kind of to me, the best of all worlds, because you're often using precedents or comparables to think about terminal value, but you're using a real world capital structure with a real world interest rate that's knowable today. And as the equity guy, I care more about like theoretical risk and theoretical optimal capital structure based on a bunch of comps that are imperfect versus what I believe the market will bear today.
And what I would say is maybe before we get into that, because I think that's exactly where we're going is why this is used in some of the shortcomings, right? And so I think all of us were investment banking analysts, right? And the first thing they do is teach you how to do market comps, which was a much more cumbersome exercise back in our days, right? You're like getting CDs and printing out 10Ks and Qs and like highlighters and finding things. And then some VP would knock you on the head because you had a typo or like all of that's pretty much automated now, right? The comparable transactions were pretty good. Problem with both of those, right, is they're historical and they're not always very good. They're not very comparable. The thing that I had on the DCF, like as an investment banking analyst, when they teach you how to value a company for their purposes, it's really about what do they think is a broad range that a market will value something. And so they use like market costs of debt, market costs of equity, pretty high level assumptions on the future. And then they'll spit that back to their client and say, here's what the company is, because we don't care what an individual thinks about it. We care what the market in total will think about it. And so it flies at a much higher level and it gives a much broader range. And I remember the second I came from investment banking into PE, I was ready to show my DCF skills. And he immediately was like, what are you doing? Get that out of here, kid. Like, what? No, let me show you how I unlever and relever betas. And we will not bore our audience on that. You can Google that or ChatGPT it. But there's this thing to kind of like remove bias and do all this theoretical mumbo jumbo. And some of the stories that we would talk about when I was going through business school and they were teaching all this stuff. I happened to have been at that point, I was already a vice president at a private equity firm, and I was going to business school because the private equity firm was paying for it, and they said I needed the credential. And so I said, great, I'll take a free MBA. And so the big story was like, I know exactly how it's done. And my group was 4 of us. We're all like overworked. We've got day jobs. We're doing this full-time curriculum. And we're all kind of like, we help where we can. We're in the finance class and they go, okay, you're going to value a company. That was like a real buyout transaction. I go and like, team, I got this. I'm just going to just get this thing knocked out. It's going to be awesome. I officially don't have to do the next 3 projects because I'm going to do the whole thing myself. And they're like, yeah, that's awesome. And so I take it and I just do the whole thing. I actually call the actual bankers that were involved and I get all the thing done, like the real life set. We get our grade back and it's a C.
What? What?
Because I used all the real world stuff. And I was like, what are you talking about? I go to the professor's like, well, you did not bring earnings into steady state. You didn't lever and unlever your betas and your capital structure was not the same. I was like, this is exactly how I saw this deal. This is exactly how it was valued. Needless to say, the group was so pissed at me. So why is that different? It makes sense. Like you buy a company based on the future. You look at what other people are paying for stuff, either in the public markets or like historically. Why did I get a C on that? And why should I have really gotten an A?
You bring up an interesting point with the story, which clearly left an impression and maybe a bruise or
still
a mark.
Upset about this.
You're still upset about it. There's a couple of things, right? So we're talking about valuation, and I think we mean in the context of pursuing an investment, a company you want to own and buy. Arguably, that's different than a more academic, quote unquote, valuation of a business as if you were conducting your quarterly portfolio valuation, right? Where you would use those three pillars that Doug laid out and then apply some judgment as to how you weight them to say our portfolio investment is worth X, Y, or Z. In which case you do use all three of those, the public comps, the M&A comps, the DCF, maybe an LBO model, and then decide how you want to weight those four elements to come up with a valuation. But I think we're talking about how do you value a business that you want to own, that you want to go buy, right? And the DCF is helpful, gives good guidance, but ultimately you have to figure out what is the current market for this business that you want to own. And so you got to go talk to bankers. You run your own LBO model, which has assumptions like a DCF as well. Depending on the size of the business and the nature of the business, the industry it's in, there may be relevant public comparables, often not. So a lot of it does depend on the M&A multiples, M&A transactions that have been in the space, and you tend to weight the more recent ones more than some of the older ones. And ultimately that takes a lot of, like you did in your class, you call bankers, you call other private equity sponsors, and there are data sets out there that you can subscribe to. But that's often where you get the most input into your decision on, okay, what am I willing to pay? What is this thing worth? What am I willing to pay? That's kind of how it really happens, right?
This episode is brought to you today by HCI Equity Partners, a lower middle market private equity firm focused on partnering with family and founder-owned manufacturing, service, and distribution companies. ICV Partners, an innovative private equity firm supporting management teams of leading companies at the lower end of the middle market. And Blue Wave, the business builders network connecting the most proactive business builders in the world with the best of the best service providers for critical, variable, on-point, and on-time due diligence and value creation needs. Now back to the episode. Let's dig into the LBO part of it, because I think that's really where we're going here. What is a LBO, aka leverage buyout model? How is it similar to a DCF, and how is it different?
So with the LBO model, different than the DCF in some respects, your valuation answer is going to be driven by the debt capacity that those set of projections can support. And that debt capacity is heavily influenced by the current market terms of debt in the moment. So you can have the same underlying set of projections around a business if you are in a credit tight environment where leverage levels are maxing out at 4 times and debt is 10, 11%, and there's a fixed charge covenant that you need to adhere to, you're going to get a very different valuation, i.e. lower than if it's a wide open risk seeking credit environment where folks will go to 5 or 5.5 or 6 times leverage and there is no fixed charge covenant and interest rates are 5%, 6%. You get a very different valuation answer simply because of the credit terms. So to me, that's the biggest difference between a LBO model and a traditional DCF. The answer is heavily driven by credit terms and credit availability that you assume in the model.
So like on your DCF, you're going to say, here are like the market capitalizations. Here's what the market cost of debt is. And you're going to look at a bunch of public companies and see what they pay for debt on average. You're going to look at the cost of equity through some very kind of theoretical calculation. And then you're going to take all those balance sheet and cash flow statement and discount the cash flows back to get to like a current value, right?
Correct.
But your LBO model, what you're saying here is you're going to still do your income statement and your balance sheet, your cash flow, but you're going to overlay very specifically the capital structure that you know you can get and use without breaking the business based upon actual conversations with lenders in the marketplace.
Yeah, exactly. Doug mentioned it earlier. The real world capital structure today that's available. That's one of the bigger differences, I think, between the answer you get from a DCF and the answer you get from an LBO.
Yeah, and like it's a small byproduct, but obviously that changes. Like a DCF is using this optimal capital structure, which implies a certain effective tax rate. The LBO, given more leverage, more interest expense, has a different kind of tax shield benefit. And then just the other one that's a little bit different is often in an LBO, you're going to pick a terminal value exit multiple. And in a DCF, you may do that, but you also may do like a cash flow perpetuity growth rate calculation. And personally, I think that's skewed toward more academia as well. So I think like using a kind of expected multiple of cash flow is a more market-based approach. So in general, basically, I think it's like the LBO model is a more market-based approach where you have more inputs that reflect the way you will manage the business versus what the market would say is theoretically the norm.
And I think you highlighted, again, one of the key issues with both, whether it's a DCF or an LBO model, is that most of the value on your projection comes 5 years out when you have the least conviction, least information, and you're taking the biggest flyer on what's the exit multiple going to look like in a very far away time, in a galaxy far, far away, with a business that's going to be fundamentally different, right? And so you're like, yeah, I guess you end up being kind of triangulating. Well, here's going to be our entrance multiple. And then you say, well, this is probably our exit multiple.
And to that point, Sean, a lot of private equity firms just make an assumption. No multiple expansion, your purchase multiple and your exit multiple are the same. Or in the last few years, some people will say, well, you may have higher interest rates in the future over the next 5 years. So take your exit multiple down a turn or bump it up a turn. It depends on people's points of view. But you can play with that more directly in an LBO model where it's a little bit more straightforward than a DCF and all the assumptions that are baked into your discount rate, your weighted average cost of capital.
Yeah. So I think this is an entry point into a really interesting conversation about where in the private equity market are we talking. I would create the general analogy, and this is not perfect, but the larger cap you go, the more you are an investor. The smaller cap you go, the more I think you are a business builder. And that has some really interesting implications in the context of modeling. So for example, for us, when we're making investment decisions, if I don't see multiple arbitrage, I probably am not going to be interested in doing that deal. And I'm willing to bet on multiple arbitrage to my benefit because I intend to do things to the business that will make it infinitely more saleable and a better, more scaled business. And so I think that's where the market's really matured over time, is people willing to bet on what you can do with an asset versus assessing what it's worth in a steady state kind of assumption.
I think that's a great segue here. Let's talk about what goes into these models. And maybe to set the stage, there's going to be essentially a projection that you feed into the model at a very high level. You're going to have an income statement, which is the revenues, the cost of goods sold, the operating expenses, the taxes you pay. You're going to have a balance sheet, which has your receivables, your expenses, your payables, your property, plant, and equipment. And then you have a cash flow statement, which essentially bridges the two. Many people will tell you it's the cash flow statement that matters most, but it really depends on kind of where you play. And so there's a lot of information that needs to be fed into that ultimately at the end of the model tells you what the company is worth. after you grow EBITDA, you build cash, you give a portion of the capital structure to the management team to incentivize them. And then ultimately you get paid your money as an investor on behalf of your LPs. How do you decide what goes into that income statement, balance sheet, cash flow statement that ultimately allows you to get to a purchase price at the end of the day? So maybe starting with the income statement. How detailed are these for you all? What are you using as the basis to start the model? How do you figure out where to project revenues? How do you understand what kind of gross profit margin you're going to have? What kind of expenses? What's the process that leads to all of that?
I think it's flawed logic to think about these models as a model of one homogeneous business. Because when you start making assumptions like revenue is going to grow at X percent and gross margin will stay constant and overhead and G&A is going to be X percent of revenue, there's really no fidelity and very few businesses behave that way. A good model is uniquely designed to the attributes of the business. And so you often have product categories, service lines, or revenue channels that dictate how each one of those behave. And many times you'll see a business where it's growing at 8% in aggregate, but one aspect of the business is growing at 20% and one aspect is an annuity. And so like you got to get that figured out. And then those same business lines have very different margin profiles. And so kind of you need to break that out. And then the same thing happens when you think about like the overhead. Some of it scales with revenue and size as a normal growth, and some of it is fixed, which should drive operating leverage. It's less about the complexity of the assumptions and more about really understanding the drivers of the business and having a view on each aspect of that business.
So your teams will do some very detailed work, like on the income statement. We're going to say, hey, you're going to sometimes project revenue by product, right, or category or business line, and profitability by that. And so you're getting to know the unit economics of the business, and you're going to project that. And then you're going to project operating expenses, sometimes down to the people, right, that you're adding. It's a very detailed, but also dynamic way, right?
Not only does that influence how you think about value, but I think that's how you get to know a business to decide, is the forecast that the seller's proposing realistic? Do I think this is a good business? You learn a lot about like the individual customer cohort trends, product line attributes, where the margin's coming from, et cetera.
Yeah, I think that's right, Doug. And you were asking Sean, like what goes into the models. You have to get a good enough understanding and get to a sufficient level of detail to understand the drivers. Sometimes you have to go way into the weeds so then you can take a step back out and abstract and figure out, okay, this is what really matters. Like you don't want to necessarily build a model that goes down to every single SKU, every single employee, or every single whatever store location. Sometimes you want to actually do that, but the point is you don't want to lose sight of the forest for the trees or the bark on the trees, right? But sometimes you have to go to that level of detail so then you can step back and figure out, okay, this is what really matters. But ultimately you want to be able to understand volume and price for your revenues, distribution costs, discounts, spoilage, depending on the business model, gross profit, direct costs for production, direct costs for delivery, et cetera. You want to understand that well enough to understand what are the units. Is it hours of labor? Is it number of units produced? Is it number of SKUs? Is it whatever that drives the revenues and the profitability of the business? That's what you want to have in your model. And it can take some time to kind of figure out what the right drivers are and which other ones are tertiary or actually not particularly relevant. That takes some judgment. That does take some work to get to that point. And Doug, to your other point about business building, you definitely do want to have an understanding for the business, particularly when you're talking about smaller companies. It's usually more straightforward to understand what the drivers are.
What diligence streams are you feeding into this thing to inform your answers?
Q of E is obviously a big one, quality of earnings. We kind of think about it as commercial diligence, and commercial diligence would be like voice of the customer, assessment of the product, understanding like the end market, what's the backdrop in terms of growth rates, how discretionary is the product versus consumable, recurring, those kind of things. A really fundamental question is like, what's the entry point here? And so it's not just the forecast, but it's the starting point. My analogy would be nobody wants to sell a business when it's not performing. So almost everything we look at is performing in a way that is growing reasonably rapidly. And you kind of got to figure out, is that an abnormal growth profile? Or should I capitalize the run rate of the business relative to the historic profile to figure out what is the market clearing price today?
So as I kind of hear what you're saying, you're using your quality of earnings review, which is what your accountants will put together to say, here's the true verified financial performance of the business. You can use that then to apply to get validated, confident metrics that can then serve as the basis to have relationships and a projection as they go forward. So we know that here's the true relationship between cost of goods sold and revenue and operating expense over time. Then you can use those metrics as levers to grow with a business.
I agree with everything you said, with one caveat, which is I think there is a judgment element where you say Q of E, quality of earnings, is a reflection of like what GAAP is generally. And then you say, how comfortable am I that that's going to repeat itself? So did you have an abnormally profitable or unprofitable contract? Did you have one big contract that may not hit again? Then you're kind of like socializing with judgment, what's recurring or what's normal behavior.
Your quality of earnings are generally looking at your recent history, right? Often the trailing 12 months up to some point. So the question that I guess we're raising is, when you think about valuing a company and paying for a company, are you basing your valuation on the latest 12 months of actual performance? Are you trying to value it based on the next 12 months of expected performance, or your judgment on what the company is going to do in the next 3, 6, 12 months? Is valuation backward looking or forward looking? How do you balance the two?
Yes.
Yes and yes.
And I think that's a great point. It's a scatter plot. There's no one answer, right? You're taking all of this and have to make judgment.
I agree. To me, though, at the end of the day, when the investment's over, you will only care what the business was going to do, the forward looking. But I think you get conviction in forward based on run rate and based on history. They complement the real thing I care about in giving me the ability to get comfortable with it, I think.
And Doug, what do you mean by run rate? Just to make sure we're speaking the same language.
We often see situations, or we make arguments for situations when we're selling where, hey, we just want a big customer. That customer is going to ramp up over the next 18 months. It's a 5-year contract. And in the last 12 months, it's 20% of what it will be when it fully matures in the contract. You should give me credit for that kind of run rate. So a lot of times you see rapidly growing businesses, I think people will give you credit for as is today versus the trailing 12 months, which are not reflective.
Got it. So paying you for efforts, work, projects, customers, contracts, whatever it is that are in place today, but that are at the early stage of development, evolution, ramping up. So in the recent financials and the backward looking financials, there's not much evidence of what it can do or what it's expected to do.
Yeah. And I guess I would say the quality of these arguments are all different, but the same way when you market a company or you're evaluating a company, there are often adjustments to EBITDA for things that are costs that will no longer continue. Maybe we move to a new location so that you're pro-forming in that new location, which has not been in the last 12 months. Revenue and growth add backs, I think, are a little bit harder. But I think depending on the nature of what the growth is, I think some is more underwritable than others.
And this is a good point for our listeners. When you're selling a company, and investment banking is selling it, they're going to do everything they can to say everything that was a little bit odd but only happened in theory once is extraordinary. So that doesn't count. It's going to be called an add back. Well, that was a one-time cost. We only have recalls once every 1 year, so we're going to add that back. I mean, obviously, tongue-in-cheek there. And so there's been this trend in investment banking. They're doing their job, but saying like it's EBITDA before expenses. Anything they can, they want to add it back. And then, Doug, to your same point, you also want to say like, hey, if our last quarter is our best quarter, let's multiply that times 4. So you're really not paying 12 months of history. You're paying on an annualized version of the last quarter. So we can say that EBITDA is even better. Now, that's if you're selling.
And I think sometimes people get comfortable in I'm paying 9 times on a trailing basis, but 7 times on a last quarter annualized basis in a business that's not seasonally volatile. It's kind of back to this. You have more comfort that it's growing nicely. You can lean in.
And that's one of the big areas your quality of earnings people will also dig into is like, how valid are these add backs and this kind of annualization of recent performance?
Hey, Sean, you bring up another interesting point on this real world valuation discussion we're having. You talked about valuing a business based on EBITDA, and that's frequently the convention. When you go through that exercise, though, of building out your DCF, you will also see for your own self if there's a disconnect between EBITDA and cash flow, right? So is there higher CapEx? Is there increasing net working capital intensity? That will be a deduct to your cash flows and put some more separation between EBITDA and free cash flow. Because ultimately, you want to value a business as off of free cash flow. I'm raising a point that's in the pro column for DCF, but it affects when you're actually in the process of trying to buy a business, something for you to watch out for. Because oftentimes people will look for a multiple on EBITDA. And if cash flow is actually equal to or better than EBITDA, that tells you one thing. And if it's materially less than EBITDA, that informs your valuation view the other way.
I don't own any businesses where it's more. So you're buying good software and all kinds of good stuff, Lloyd. All my stuff has DA.
But it's a great point. I think that's one of the reasons why a lot of PE firms don't use these multiples as their primary example, like EBITDA, enterprise to EBITDA multiples. Warren Buffett had this great line referring to EBITDA is utter nonsense, and he's called it's earnings before everything important. It's the DA. And what that means for our listeners, it's depreciation. It's the capital expenditures that are massive. You're paying taxes. And Lloyd, to your point, it's so right. It's like at the end of the day, it's cash money. What are you getting at the end? If you got cash money, then it's good. So maybe to frame this, you're doing these very detailed models that are as much about making sure that you understand how the business works. And so the process is as important as the outcome. You are using that to create projections of not only the income statement, but you're also putting in things like your taxes. You have a balance sheet, right? You're projecting like how your working capital, your accounts receivable, your payables, very importantly, your capital expenditures. If you're a manufacturer, that's huge money that has to be. So you got to buy equipment and you got to maintain it. And then you project this forward. And now you're at this point of like, you're trying to figure out the price. And there's some circulars here, right? And so it's one, what's your capital structure? Two, what you pay for something makes your IRR, your internal rate return at the end of the year change. And so talk to us about like, now you've got your base case. And then maybe we'll bridge to this. You're often doing kind of an upside case and downside case. You want to know a full range of outcomes. How do you then triangulate into what you think the actual fair price for you as an individual willing buyer is?
So honestly, Sean, it'll come down to the buyer's psychology and emotional state at the time. It's ultimately going to be a human decision. So you can run the numbers. You can run the LBO model. You can run DCFs. You can run scenarios, upside case, downside case. And those will often provide you with guardrails. If we're wrong on these factors on growth or wrong on this factor for cost, and we have a downside case and there's a recession, et cetera, you play with all of that and you're like, okay, this is how bad it might be. If that's acceptable, then you move forward. If it's not acceptable and that's not an acceptable risk, even if you try to stick your thumb in the air to figure out how likely that is, then you walk. So let's assume you've done all that. Downside case, base case, upside case, and you're still within parameters that work for you. The question you're asking is, well, where do you draw the line when you're trying to buy the business? And then it becomes a bit of an exercise in negotiation. How badly do you want this investment? How confident are you in your value creation plan? How confident are you that you can go take down the next 3 or 4 add-on acquisitions in the next 6 months or 9 months and then double your EBITDA or increase EBITDA 50% in the next 6 to 9 months? All of those things that are going into your perception of the opportunity affects your valuation. And you have to have a bit of a bid strategy or negotiating strategy. If you're cutting a deal directly with the company, how much do they want? informed by your market intelligence from talking to bankers. You have a sense for what a business like this is going for. An extra $1 million, an extra 2 million, extra 10, an extra 15. You start to play with that in your own head with your numbers to figure out how much are my returns affected. Do I want to take more debt on this business, or do I restrain the leverage I put on it and save my debt capacity for another reason, another use a year from now, 2 years from now? You have to go through all of that for you to make that final decision as to whether here's my final price. And when they come back to you and it's like, oh, can you do a little bit more? Because they always will. Well, sometimes it's just to give someone a token win in the negotiation. Other times it's a real, if you don't pay more, someone else truly will buy this business and get it from you. So you have to factor all those things in. It's not a simple black or white, yes or no kind of answer. The answer is not always 17 or whatever, right? It's a combination of those things. It's judgment.
So a 20% IRR is not always a 20% IRR, right? And so I'm a vice president and I've got a partner staring over my shoulder and we're with the model. We've got the projection that we all feel comfortable with. We know here's the capital structure that we can use. We know what we're going to allot to the management team. And then he's just like, okay, raise the purchase price $1 million. And that spits out an IRR, internal rate of return. And then they're like, okay, raise it another $1 million. Okay, raise it $1 million. Oh, take it down 500,000. And as you're iterating, you're like, yeah, I think the risk adjusted return that we need, given everything we've learned, it should be a 21% IRR. But there's other ones where like, you know what? This is a slam dunk company. We're going to take 17% and let's just win it and let's park it. I don't know if you all do that. At the end of the day, like if I'm just like being cards face up, that's what I would do. So there's almost this concept, and I never really thought about it until you were talking about this, Lloyd, but it's like there's IRR times like an expected value quotient that you need to do. It's like 20% times 0.9. And then I never really did it that way, but it seems like you almost need to do that because they're not all equal.
That's right. One of the things I personally believe you have to be careful on and be on guard for with models is that false precision. I don't think anybody is so good in private equity to say this deal is a 20.0% IRR versus a 19.9 or 20.1. That's false precision. That's why I think it's better to think about ranges of returns, to be honest. But to go back to your example, you do have to iterate multiple times. So if we pay $5 million more on your price, your returns drop. So what would we need to do to get that return back? So what if we got our net working capital down 2 percentage points going forward, starting in year 2, 3, 4, and 5? Or what if we skinny CapEx? Or what if we found a way to have more salespeople in years 1, 2, 3, 4, or whatever? Like you can start playing with the trade-offs and whether those trade-offs are reasonable or a stretch, right? Again, more judgment to answer your question. That's how you would tackle that.
And that's where the investment committee also comes in, right? They're going to come in and they're going to challenge you on all these assumptions in a very detailed way. There's checks and balances, but to your point, like at some point you start either removing some of the sand that you put in your model as like cushion to get to where you need to be if you're getting broader and broader conviction that that's an asset you want to own, or you're just going to be realizing that you're going to be taking on maybe incrementally a little bit more risk in order to get that same return. At least that's the way I would think about it. But at the end of the day, there's so many variables. There's no exact science to this thing.
I just want to reinforce a couple things you guys are saying, because this gets back to like, we talked about academia versus in practice on the modeling side. Let's talk about how important the modeling is. It's just one of many tools that I think drive conviction. So I really like it as a valuable way to think about the business and force the discipline. But then I translate it into real world and I make a couple points. The first is you do all this to figure out in a status quo environment, what is the business in theory worth? And then you've got to ask yourself, well, how does that match up with what the market will pay today? Because you may conclude it's a weak process. You may conclude this CEO is exceptional and he wants to roll over 50% and you want to be his partner. And so that's a big risk element. So I think you got to like use this as one of many things, but you could dramatically change your answer based on external factors. The other thing that's happening in my mind is the disconnect of what assets are worth to individual buyers is growing, because I think the qualifications and capabilities of buyers continues to get better. Just our own circumstance, we do lots of consolidations. So in my models, we're assuming some crazy uninformed things like I'm going to buy a business at 8 times. I'm going to buy 10 of those in the future, yet to be determined. And then I'm going to assume that collectively those assets trade at 12 times, right? And so you think about like some of those assumptions, those are super powerful in the context of what it implies for the financial model, but they're kind of unknowable. And so you got to kind of like figure out how you're going to risk adjust the execution of some of those elements of your strategy.
You're betting on your skills to a certain degree as part of this exercise, in which you have to, right? That's part of being a business builder.
Yes. It's kind of like the LBO model, I think, tells you what the market is willing to pay. And then you got to decide what is it worth to me given the strategy I intend to employ.
That's right. And again, what is it worth to you is often shaped by not only your skill, as you mentioned, Sean, but just your broader awareness of the market that you're playing in. We bought a business, and based on our understanding of the markets and the supply chains and the customer dynamics around this business, we knew that one of their key inputs, the price was starting to tick down. So as we were going through diligence, we paid attention to it and saw that it was going down and was going to continue to go down through our first year of ownership. So when it came to preparing for that question, hey, we like your price, we like you as a buyer, can you move your price up? We were ready for that because we knew our profitability was going to increase each and every month, at least for the first 6 months of our ownership post-close, if not for the first year. So we didn't have to get that question. We held our price. We didn't have to raise it, but we just held it. But we had a lot of conviction because we had intelligence on where the key supply inputs, the price of that was going. Their costs were going to go down over time.
Those are great points that both of you made because like your diligence is giving you what's called alpha for our listeners. Like, you know, you're going to have up to 100, sometimes more than 100 interested parties starting off on a broad auction. They're all going to get a data room. They're all going to get lots of information, which makes each of you all much more informed than a public market investor usually, right? But then you're also using the unique skills that you all have within your firms to give yourself insights that no one else knows, which is what's called alpha in the industry, right? And that helps you kind of inform your bid. And then to your points also, you're also looking at public market comps. You're looking at comparable transactions. And there's just so much game theory as well, like what's important, right? Because there's valuation is only one of the 3 components that were really needed to close a deal, right? It's valuation, speed, and certainty. You know, if you can say, I'm going to close fast with 100-degree certainty, you're probably going to beat the highest dollar closer if you're in the range. There's so much complexity that's layered in what you all do, particularly when it comes to owning a business that's highly sought after.
I think that's right.
One last thing, is there anything as we look forward that you're at least noodling on in terms of how to use these kind of valuation techniques, realizing the world is moving fast?
I'll throw this out to our listeners. I've been toying with the idea of Monte Carlo simulation. And so given my view that I mentioned earlier, but most of your key assumptions aren't sort of point specific. You don't have point precision on your assumptions. They're generally kind of in a range. Can you run different scenarios around the range of growth, the range of net working capital assumptions for all the elements of net working capital, CapEx assumptions, and all the other elements we talked about that go into your model? Can you run that through a Monte Carlo simulation and get a fan, a spread, a range, a distribution of returns and see whether you're looking at some asymmetric profiles, right? Is there a skew in the returns, positive or negative, right? That is where I personally would like to go. And so if there's anybody out there who's listening, who's got this figured out, hit me up on LinkedIn and I'll bring my notebook and you can come teach me how to do that.
It's once again using these advanced statistical techniques that are being kind of democratized for everyone make a lot of sense. Like, how do you get more and more bringing science into the art of your business as well? How about you, Doug? Anything that you're kind of playing with?
I think I'm pretty interested in tools that can be productivity tools for my team to look at these things more quickly and efficiently and replicate. I'm a little bit of the belief that because it's an observation set of one, I've got the business that I'm underwriting. It's hard to make meaningful assumptions about distributions and come up with great insights, at least for me. I'm more interested in pushing the envelope on how do we get better at bringing value to the business post-acquisition. So like if there's two ways to compete, one is refining my underwriting process and the other is being a better business builder. I think there's more opportunity with technology there than the underwriting, at least in the context of our model and how we're thinking about it.
I think that's right. As I kind of distill everything that I've learned from you all today, I think the takeaways that I have are PE valuation is not like a point on a map. It's the scatter plot on this multi-dimensional plane. And you're really trying to figure out where the right answer is and from that. And so it's not just X times Y equals Z, right? And then these models that you're using, it's the process is as important as the output. It's the insights that you're learning that you're putting into them that are really what ultimately gets you there. And your competitive advantage not just comes from paying the highest amount. It's the proprietary insights. It's the edge, the alpha that you have that's going to enable you to turn that company into something that was fundamentally probably it wasn't intended to be a year ago. And then you have some tools that are coming on that are going to help you get better at it. But at the end of the day, it's the process that really gets to the right outcome.
As always, you packaged it nicely, Sean.
Masterful.
All right, gentlemen. Another great PE MBA class here. So I appreciate both of you.
Thanks, man.
Thanks, Doug. Thanks, Sean.
A special thanks to HCI Equity Partners, a lower middle market private equity firm focused on driving transformational growth through consolidation strategies by partnering with family and founder-owned manufacturing, services, and distribution companies. Learn more at hciequity.com. ICV Partners, an innovative lower middle market private equity firm supporting management teams of leading companies at the lower end of the middle market. Learn more about ICV at icvpartners.com. And finally, Blue Wave, the Business Builders Network, connecting the most proactive business builders in the world with the best of the best service providers for critical, variable, on-point, and on-time due diligence and value creation needs. Learn more about Blue Wave at bluewave.net. For further information on HCI, ICV, and Blue Wave, and relevant topics discussed here in the episode, please see the episode notes for links.
The views and opinions expressed in this program are those of the individuals presenting and do not necessarily reflect the views or positions of any other persons or entities, including those referenced herein. No representations, warranties, financial, legal, tax, or other advice are made herein. Consult your advisors regarding any topics discussed during this episode.